In November 2022, one of the largest financial frauds in American history unraveled in just 10 days. Sam Bankman-Fried, a 30-year-old billionaire with messy hair and cargo shorts, had built FTX into the third largest cryptocurrency exchange in the world. He was worth $16 billion. He was on the cover of Forbes. He donated millions to politicians. He was supposed to be the good guy of crypto. Then it all collapsed. $8 billion of customer money, gone. A company valued at $32 billion, worthless overnight. And Sam Bankman-Fried? He's now serving 25 years in federal prison. This is the story of FTX. Sam Bankman-Fried grew up in California, the son of two Stanford law professors. He studied physics at MIT, where classmates described him as brilliant but scattered, the kind of guy who'd play video games during meetings while still somehow absorbing everything. After college, he took a job at Jane Street Capital, a quantitative trading firm on Wall Street. It was there he discovered something that would change his life: cryptocurrency arbitrage. In 2017, Bankman-Fried noticed something strange. Bitcoin was trading at different prices on different exchanges around the world. In the US, Bitcoin might be $20,000. In Japan, it might be $22,000. In South Korea, even higher. This was free money if you could move fast enough. At 25 years old, Bankman-Fried quit his job and founded Alameda Research, a cryptocurrency trading firm designed to exploit these price differences. At its peak, Alameda was reportedly moving $25 million a day. But Bankman-Fried wanted more. The exchanges he was trading on were slow, buggy, and poorly designed. So in 2019, he decided to build his own. FTX launched with a simple pitch and a better crypto exchange, built by traders, for traders. It had features other exchanges didn't: sophisticated derivatives, lower fees, and a user interface that actually worked. It grew fast. Really fast. By 2021, FTX was handling billions in daily trading volume. It had over 1 million users. Venture capitalists were throwing money at it. Sequoia, SoftBank, Tiger Global. The company raised nearly $2 billion. In January 2022, FTX was valued at $32 billion. Bankman-Fried's personal net worth hit $16 billion, making him one of the richest people under 30 in history. He bought the naming rights to the Miami Heat arena for $135 million. He ran Super Bowl ads with celebrities like Tom Brady and Larry David. He became the poster child for cryptocurrency going mainstream. But behind the scenes, something was very wrong. Remember Alameda Research, the trading firm Bankman-Fried started before FTX? He never really separated the two companies. On paper, Bankman-Fried stepped down as Alameda CEO in 2021, handing control to Caroline Ellison, a 28-year-old trader who was also his on-again, off-again girlfriend. But Bankman-Fried still owned 90% of Alameda. And the two companies shared employees, shared offices, and critically, shared money. FTX customers depositing funds on the exchange had no idea their money wasn't staying at FTX. It was being funneled to Alameda Research. In May and June of 2022, the crypto market crashed. Bitcoin dropped from 60,000 to 20,000. Many trading firms took massive losses. Alameda was one of them. To cover Alameda's losses, Bankman-Fried made a decision that would later be described as one of the biggest financial frauds in American history. He took customer deposits from FTX, money that people believed was safely held on the exchange, and gave it to Alameda. Not millions. Billions. By the time it was over, there was an $8 billion hole in FTX's accounts. FTX even had software specifically designed to hide this from auditors and customers. When regulators or investors asked questions, the software made it look like everything was fine. There was another problem. A ticking time bomb. FTX had created its own cryptocurrency token called FTT. On paper, FTT was worth billions. Alameda held a massive amount of it, using it as collateral for loans and trades. But FTT's value was essentially made up. If everyone tried to sell FTT at once, there wouldn't be enough buyers. The price would collapse. And that's exactly what happened. On November 2, 2022, a crypto news site called CoinDesk published an article that would bring down an empire. The article revealed that Alameda Research's balance sheet was stuffed with FTT tokens, the cryptocurrency created by its sister company FTX. This wasn't some small concern. A huge chunk of Alameda's supposed assets were in a token that only had value because FTX said it did. It was like discovering that a bank's reserves were mostly IOUs to itself. Changpeng Zhao, known as CZ, was the CEO of Binance, the world's largest crypto exchange and FTX's biggest rival. Binance owned a large stake in FTT, acquired when they sold their early investment in FTX. On November 6, CZ announced on Twitter that Binance would be selling all of its FTT holdings, about $500 million worth. He cited recent revelations as the reason. But everyone knew this was war. The announcement triggered a panic. In 48 hours, customers tried to withdraw $6 billion from FTX. But the money wasn't there. On November 8, something unprecedented happened. Binance announced it had signed a letter of intent to acquire FTX. The two biggest rivals in crypto, merging. For about 12 hours, it looked like FTX might survive. Then Binance team looked at the books. On November 9, Binance pulled out. They issued a statement saying the problems were beyond our ability to help. Reports emerged that FTX had mishandled customer funds and was under investigation by the SEC and CFTC. FTX was done. On November 11, 2022, FTX filed for bankruptcy. So did Alameda Research. So did more than 100 affiliated companies. Sam Bankman-Fried resigned as CEO. He was replaced by John Ray III, the same man who'd overseen Enron's bankruptcy 2 decades earlier. Ray would later say that in 40 years of legal and restructuring experience, he had never seen such a complete failure of corporate controls. There were no proper records. No board oversight. Company funds had been used to buy personal real estate for employees. FTX didn't even have an accounting department. For weeks after the collapse, Bankman-Fried stayed in the Bahamas, giving interviews. He claimed it was all a mistake, bad accounting, not fraud. He said he didn't know where the money went. On December 12, 2022, Bahamian police arrested him at his apartment. The US had filed criminal charges. The case went to trial in October 2023. 3 of Bankman-Fried's closest associates, Caroline Ellison, Gary Wang, and Nishad Singh, had already pleaded guilty. They agreed to testify against their former boss. Caroline Ellison, his ex-girlfriend and Alameda's CEO, was the star witness. She told the jury that Bankman-Fried directed everything. He told her to take the customer funds. He told her to hide it. He knew exactly what he was doing. The defense argued that Bankman-Fried was disorganized, not criminal. That he made mistakes but never intended to steal. The jury didn't buy it. On November 2, 2023, exactly 1 year after the CoinDesk article, Sam Bankman-Fried was found guilty on all 7 counts of fraud and conspiracy. On March 28, 2024, a federal judge sentenced Sam Bankman-Fried to 25 years in prison. The prosecutors had asked for 40 to 50 years. The defense asked for 6.5. The judge landed somewhere in the middle, calling the crimes extraordinarily serious. Bankman-Fried is currently incarcerated at a federal prison in California. He won't be eligible for release until his 50s. Caroline Ellison received 2 years. Gary Wang and Nishad Singh received lighter sentences for their cooperation. The FTX collapse wasn't just a crypto story. It was a story about what happens when nobody checks the homework. Venture capitalists invested nearly $2 billion in FTX with minimal due diligence. Some investors spent just 30 minutes on calls before writing 9-figure checks. They believed the hype. Regulators were asleep. FTX operated in a gray area between securities and commodities law, with nobody quite sure who was responsible for oversight. That confusion let billions in fraud go unnoticed for years. And customers trusted their money to a company that didn't even have an accounting department. A company run out of a luxury penthouse in the Bahamas by a group of 20-somethings who played video games during meetings. FTX's collapse triggered a crisis across the crypto industry. Bitcoin fell to its lowest price in 2 years. Several other crypto companies, including BlockFi and Genesis, filed for bankruptcy in the aftermath. It also triggered a regulatory crackdown. In the year since, authorities have been far more aggressive about treating cryptocurrency platforms like the financial institutions they are. It's easy to forget that behind the billions in losses were real people. 1 million FTX customers lost access to their money. Some lost their life savings. Some were traders whose businesses collapsed overnight. Some were ordinary people who thought they'd found a safe place to store their crypto. The bankruptcy proceedings are ongoing. Some customers may eventually recover some of their funds. Many never will. Sam Bankman-Fried built one of the largest financial frauds in American history, and he did it in plain sight. He wasn't hiding in the shadows. He was on magazine covers, at conferences, meeting with senators. He donated over $40 million to political campaigns. He talked constantly about effective altruism, using money to do the most good. Maybe he believed it. Maybe it was always just a cover. We'll never know for sure. What we do know is this: a 30-year-old with messy hair and cargo shorts convinced the world he was building the future of finance. And then he stole $8 billion. Every empire falls. Now you know why this one did.